talking about when you look at hindsight's 2020, but it's important to know. So when you go back and look, how could you make hindsight real time? So it's 2020 in real time. So if you look at our red dotted line, it comes in like that, right? So the market breaks down into that area of 75 and then bounces. And this could be the price of anything. So you're looking for a reaction like that to play resistance and then capture some more downside. But you don't just get this to that to this. It's not going to look that clean. Sometimes you get exactly where it's hanging out at this red line. So ideally, in hindsight, where's the best place to get short? Not really here, certainly not here, not here, not here, even though in 5 minutes it's going to be down here. In all these locations, in hindsight, we're going to be pretty decent. However, in real time, you're not going to be able to hang on. You're going to have a lot of doubt that it's a good location. You're going to take a little bit of heat. And so you're not going to get consistent trading resistance, even if it's good resistance, unless you got a good qualifier. So ideally, when you look back in hindsight, best place to get short would be around there because soon after that, it it gets you paid, and then you end up getting this to this to this without the chop and the doubt and the worry, and you end up scratching it, taking a small winner, small loser, and then when it finally does fall out of bed, you're not on the team. So you're even more frustrated that you had the right trade, but you got out too quick. And sometimes you got out too quick and it was a small loser or a break even. Now you're really mad. And a small winner, you're mad because you left a lot on the table, but at least it's a small winner. The other ones, you're really mad because you had the trade. This is what happens so often to traders is that a lot of the trades, when you go back to review them, you were on the right side. Your timing was bad. And you fail to realize how to get better and where to get better because you ain't breaking it down. It's not your opinion, man. That was excellent. It's not necessarily your level for resistance. That was excellent. It's back to timing. So that's the ready, aim, fire breakdown. Step one, step two, step three in any approach. Everything in the world gets broken down when you go to learn it. Everything. And then you put it back together. But you learn the pieces. So trading is no different. Even if you don't break down your trades, they can be broken down. You might not do it, but everybody has a ready aim fire, whether they realize it or not. Sometimes they're ready, which is your bias, bullish or bearish, are for the dumbest reasons. You know, you're bearish because the last four trades you were long and they were losers, and so now you're bearish. That's a step one, not a very good one, but it's a step one nonetheless. All right. So what could get you short when you drill down into this idea? And that's what this chart is. It's like a magnifying glass to bring you in so that hindsight's not 2020 or it's real time 2020. And then you drill in. So you could take a shot when you see a first pink triangle, fine. But let's say you're not quick enough to get it up there. And then you see it, you get a blue, and it's a pretty decent blue, and that's going to keep you disqualifying it. And then you get resistance where? Right here at the top pink. That's key. Not only the red dotted line, but also where the sell imbalances first arrived. And you don't know it's going to hold, but you do know it's going to hold when it gives you this first rotation. So now the idea is, man, if they breach this blue and maybe we can get longs to come in, thinking the price is going to go up. Remember what more longs indicate. More longs, that's an M, equals what? More future sellers. What does the price of anything need to go down? Sellers, but future sellers. Not sellers right now necessarily, future sellers. All right, people willing to sell it at lower prices after you got short. Now, we'll play this thing and you could see if your mindset is you're bearish already and you're ready to go because you get a pink triangle and it's holding, but you don't know it's holding for sure. Now, if you get this thing to go green, you might even have a little bit more. Boom, goes green. Now, when it goes green, what is that telling you? It's telling you it went from more shorts, red, to more longs, green. But you have to anticipate, like sometimes before it breaches this blue, which means goes underneath the blue, before it does. You're anticipating it will. You know, you kind of like know, below here, they're going to run it. Above here, they're going to run it. Anticipation is a big part of trading because that's what we're doing all the time. Anticipating and predicting are essentially the same thing oftentimes. So you have to anticipate. I know what this guy in front of me is going to do. He's going to panic and jam on his brakes because the guy in front is going to pull out of that parking lot. I could see it coming. And you saw it before the guy in front of you jams on his brakes, and you don't have to plow in the back of him because you're paying attention. You're anticipating. And now these tools are allowing you to anticipate more sellers than buyers, pink triangles, more buyers than sellers, but down in here. And if you get it to get breached, a blue triangle get breached means it's going lower than where the blue triangle came in, right? It's going through the imbalance because people might say, well, Anthony, how could it go up if there are more buyers who want to buy it than sellers who want to sell it? The invisible orders, which I call market orders, they're invisible because you don't know them till they hit. They're not resting. They're not in the market. And market orders are going to drive the market. They're aggressive sell or buy orders. When you put in a market order to sell, you're hitting the bid. When you put a market order to buy, you're lifting the offer. So when you get sell market orders, they make a buy imbalance flip very quick. It's literally reversing the imbalance. So you could have a 500 contract imbalance in this 6-tick area here. That could totally get quickly reversed and does because of sell market orders. Make sense? So that's what you're anticipating. If we can get some sell market orders to come in, and we're always working on anticipating, showing you stuff that you don't have to anticipate because the markers are anticipating it for you. Now, sell market orders, an idea is to put ourselves in a position to paint the chart when we anticipate some market orders are going to come in. I ain't going to get into how, when, where, but either way, you have to anticipate that that's what it's going to take for price to go down anyways. And if you can get this laser, which is OPP, other people's position, to go red to green, that's very helpful because you are short. You don't want other shorts, but you do want other longs. You guys want to hear the analogy and metaphor again? What I mean by that about competition? It's a little edgy. We're gonna say it. When you were younger, you were single, you went to bars, you wanted to pick up a girl, and you go into a bar and there's only a few girls there. That's like being short with a lot of shorts. So then you go to another bar and you don't see many guys there. That's this. If you're short, there's not a lot of shorts there. The green is there's a lot of the other side. You need to create and understand the bar you're in and what your goal is. The goal when you're short is for price to go lower, I hope. Well, what kind of chance do you have to achieve that goal if everybody is short? And if you don't understand that, that's fine. Because when people are short, they are now future buyers. Don't believe me? Tell me the next order you put in after you get short. It's probably a buy limit, buy stop above, buy limit below, and a buy stop above. So that's easy to prove. Present shorts, future buyers. Why would you want a bunch of future buyers that have to come in if you want price to go down? Who would want that? Nobody. So shorts, if that's what you are, you want less shorts. So put a little S there. You don't want a lot of shorts if you're short. So how do you create that? Well, first of all, by paying attention to where the laser is, and then just context of you're breaching an area that did have more buyers than sellers, and you're swiping through it. And so when you see this market then go in the anticipation of this, there's no coincidence. It's not random that the market started to pick up the pace to the downside when these things lined up. because you need more people who want to sell it, not people who sell it. Sell it and want to sell it. The want to sell it is what keeps prices weak. They want to sell it. If you want to sell it, and also you have to sell it, what do people who are long do? They become sellers, right? But they have to sell it because at some point they got to cover a long position. So they just don't want to sell it. They have to sell it. And there's a lot of emotion involved in that. So you don't get a great green laser, but it goes red to green and it stays on the green side, keeping pressure on this price. You breach this guy, and so you got a head start. So if you do get short qualifying this, making real time 2020 instead of hindsight being 2020, then you come over here and you actually could see how you could execute without looking um, from the future. You know what I mean? You could see the opportunity to read it with clarity like you do after the fact. Now, once price goes your way, you're on your own. There's very few people who should try to help you trade from the upside, meaning trade from the green side. You're up money. You still have to have be coached through taking profits. That's something you should get better at doing. Don't get me wrong, but you don't always leave money on the table. But a lot of people, because they don't want to leave money on the table, leave a lot of money on the table. They're worried about getting out too early, so they don't get out, and the market comes right back to where they got short and they had a great location turn into statistically a scratch because there is another step in the ready and fire, and that's step 4, and that's getting out. And knowing where you're going to get out before you get in is important. It's one of like the very first things I learned in the late 90s when I got into this business on the floor. And one of the classes, which were on the floor, the classroom was the trading floor, and the instructors were like the brokers, and the traders were the students. And I bring this up because he walks into the classroom, which was the break room, the CME floor, upper trading floor, and he says, "Know where you're getting out before you get in." Before you said anything else. Know where you're getting out before you get in. And it always stuck with me. That's how you help manage your risk. You have to identify the risk before you could manage it. That was the problem with, you can get people all upset about the pandemic. And what I said early on with the pandemic is, hey, you're not going to manage risk if you don't identify them. I told a group of moms early on in the pandemic when they wanted the kids to go back to school, I said, the problem is everybody is worried about the risks of opening up schools too early. How about the risks of keeping them closed too long? You know what they said? You got to tell the school board that. I says, no, you have to tell the school board that. They don't want to hear it from me. They want to hear it from you. And guess what? They ain't going to do anything. But either way, that's the point. If you don't identify the risk, you're not going to be able to manage it. Hell, people will struggle managing risk when they know it's there, let alone when they ignore it. So again, knowing where you're going to get out before you get in is a part of my early education. And so you see this thing kind of develop and fall out of bed. You also could see where in real time it looks like hindsight does, where inside that yellow circle, you indeed could have executed a short, playing this idea of it goes down, you miss it, retrace to resistance, and you don't miss it. That's what you're looking for. You're looking to take advantage of this pattern. But as anybody and everybody knows, these patterns aren't that clean. This pattern I just drew in yellow is essentially this. But what it does is this chop before it then releases and gives you this downside move, that leg to the downside, which is ultimately what you're trying to anticipate and predict. And if we just like fast forward this thing, you're going to see another moment of accelerating is when you got some pink triangles. And we talk about when you see the triangles, it's important to see what price does. And then you got this big giant sell order that came. What we pride ourselves on is even if you're not on the right side, which is the short side in this sequence, you're not on the wrong side. All right? Not on the wrong side. Very few people in our in our community that would be long in this sequence. No matter how many are short, but if they had a position, it would be short. And staying off the wrong side is very important. It's not sexy. when people go out and try to coach and help other people trade, staying off the wrong side isn't something that gets their eyes to light up, but it's a very important element to trading. So keep it simple and let the markers, if you got a good tool, they're the ones figuring out all the complexities, right? The order flow and the imbalances and other people's positions and the average price people are long and short from. All that math and filtering is done for you and then painted on the chart in various spots. And then you got to read them and react to them, but you have to anticipate. And it'll make it a lot easier to react when people say, um, well, you had to be quick. Well, it seems like you had to be quick, but if you're looking for it, then that's like technically what it means to slow something down. You're anticipating something. So it's not literally slowing down, but it's slowing down to you because you're anticipating it. Could be a quarterback in football. He's going through his progression, his reads, because he has this anticipation going on in his head. They're not the brightest of people, but they're really bright at that job. So it seems like it's quick to us, but they're going through a progression, anticipating. So that's what slowing stuff down is. The best metaphor I use for that is what? Speaking another language. It seems like someone speaking a foreign language to me are speaking fast. They're not. I just don't understand it. And so we go over this highlight of just trying to create clarity in real time that you often see in hindsight. And so the hindsight being 2020 turns into real time being 2020 because you have the proper tools, you know how to read them because they're showing you what's relevant or important and information that matters. When we go over some other ones, we'll do it here in the room, but I don't want this video to go on too long. I think it covered a little bit about when to execute a retracement, using these tools.